Hello, my name's Kevin Grimes. I'm CEO and Chief Investment Officer at Grimes & Company. I'm here to talk to you today about Bitcoin as part of our Bitcoin series. This installment is called Embrace the Volatility, and we will explore just that. Bitcoin's a very volatile asset. The purpose of this piece is to explore why Bitcoin might be an asset worth understanding as a long-term holding in an investment portfolio. As always, this is not an investment recommendation. Recommendations should only be considered in the context of the suitability of each individual investor. And also, this is not a dissertation on the origins of Bitcoin or blockchain. And lastly, this piece pertains only to Bitcoin and no other crypto assets. So what we're going to be talking about today, many investors shun Bitcoin because of very high levels of volatility. We're going to explore, do the returns justify the risk? Also, we're going to frame Bitcoin as an asset and not as a currency. Get into that a little bit. We're going to explore if there's a diversification benefit to adding Bitcoin as an asset to a portfolio due to low correlations with other investment assets in the long run. And lastly, we're going to explore if volatility is declining for Bitcoin, what can we expect for returns over time in that case? Step one, Bitcoin is a very volatile asset. Volatility is what scares so many people away from considering Bitcoin as an asset. And indeed, Bitcoin is the highest volatility asset that we follow, as you can see from this chart. Also, Bitcoin is the highest performing asset that we follow. It's the highest performing asset over both the past decade and since 2009, since Bitcoin came into existence. So what makes Bitcoin so difficult for many investors is this volatility. The price over this time frame since Bitcoin has been in existence, it's experienced several declines of over 50%, including an 80% drop from the top in 2017. Many people refuse to accept that Bitcoin is a store of value because they feel that such an asset should not have the ability to decline so much in price. We're going to analyze Bitcoin versus the S&P 500 from the period of 2020 to 2024. During that time frame, the S&P 500, proxy for stocks, large U.S. stocks, has had a very strong average compound return of about 13.6%, which is actually far above the long-term averages. Over that same time frame, Bitcoin has compounded nearly 4 times higher with an annualized return of 58%. So again, the trade-off is volatility. Standard deviation is a measure of risk that focuses on price dispersion, with a higher number being more volatility. The standard deviation of Bitcoin was 73%, much, much higher than that of the stock market at about 19.5%. What happens when you standardize and you look at return per unit of risk? These measures factor in, is the volatility worth it? And the most common ratio is the Sharpe ratio. A positive Sharpe ratio implies positive returns per unit risk. And the S&P 500, pretty reasonable Sharpe ratio of 0.65. Bitcoin, despite all of that volatility, the returns justify the risk in a Sharpe ratio of 0.96. So we're not obviously sure that this will continue into the future, but as an investor, if you knew ahead of time that the Sharpe ratio was very high, approaching 1 in this case for Bitcoin, then you would be rooting for as much volatility as possible, because the more volatility would mean more return. So, is Bitcoin maturing before our eyes? This enormous volatility needs to be put in context. The entire world has been able to witness real-time pricing of an asset from its embryonic stage of existence. This has never been done before. One would imagine if there were real-time pricing of a startup company, then the volatility would be similar to that of what Bitcoin has had. And instead, venture funds that hold investments in these early stage companies price those investments very rarely, giving a false sense of what true real-time volatility actually is. And by the time the company matures to the point of being large enough and established enough to even be publicly traded and experience an initial public offering, by that point in time, the stock is already exhibiting normal levels of volatility. So something probably in the standard deviation range of about 20. But here from this chart, you can see that the volatility of Bitcoin has actually declined over time. And also, as it's declined, its return potential has declined as well. This chart shows the enormous returns in the early days. And obviously the returns are still substantial, but they are slowly declining as the volatility declines. So at this point in time, we just described Bitcoin's volatility. We showed how the returns thus far justify the volatility. So a little bit more on a use case for Bitcoin. Bitcoin is not a good currency. Bitcoin is an asset. An asset is something to own. A currency is something to transact in. Assets are a store of value. Think of Bitcoin as digital gold, right? It has intrinsic value for being scarce. So that said, Bitcoin is actually a terrible currency because when you have a high level of volatility, your purchasing power would be variable over even short time frames. So it makes it very difficult to transact in a volatile asset. Let's take the exact opposite. The US dollar is by far, I guess, undisputedly the best currency in the world. It's incredibly stable. It's highly liquid. It's fungible anywhere. You're able to facilitate transactions, almost any transaction in the world. However, holding dollars for the long run is not storing value. It's destroying value. As more money is printed, it's worth less because more currency exists for the same number of things. Prices of things increase and there's inflation. Here's a chart of the purchasing power of a dollar over time. Why would anybody want to own the US dollar as an asset? Dollars should be used to transact. Dollars should not be used to be held. So, Bitcoin is an asset. We just established that. That's how we're looking at it. How does it compare to other assets? Because the goal when building a diversified portfolio is to introduce investments with different sources of return and different sources of risk. And so ideally, we want to be introducing assets that will behave differently than each other. And a good way to measure this is a measure called correlation. So correlation measures just the variability of one asset's return relative to another. Are they going in the same direction over time or not? So the way the numbers work, a correlation of 1 would imply perfect correlation. 2 assets that are moving exactly the same. A correlation of -1 would mean a perfectly inverse return. So something that moves exactly in the opposite manner. And a correlation of 0 would mean there's no measurable correlation at all. They're just 2 assets are moving independently of each other. So as you can see from this following table, from Fidelity's digital asset group, Bitcoin's correlation to other assets is very low. So you see it here compared to domestic stocks, international stocks, bonds, credit bonds with US high yield, and then gold, commodities, real estate. And all of these are very low correlations that are far less than 0.5. All these correlations are really less than 0.33. So very low correlations to basically every asset class out there. All right, so we have Bitcoin. It's an asset. It's really, really volatile, but the returns are so good that it justifies the volatility, and it doesn't correlate very well, or it has low correlation, which is a good thing, to really all the other assets. So what's the impact of adding Bitcoin to a portfolio? Well, our friends at Fidelity, the digital asset group, did this study, which is on the screen now. we took the traditional 60-40 that everybody talks about, the popularized 60% stock and 40% bond portfolio, and they added very small pieces of Bitcoin to each of these, or to that 60-40 portfolio. They added a 1% position of Bitcoin, a 3% position, and a 5% position, and then analyzed the impact on the overall portfolio. And as you can see from the table, the annualized returns increased substantially, even with these small amounts in Bitcoin. And you can also see volatility did increase. The 60-40 was at the 12.31. By the time we got up to 5% Bitcoin allocation, the volatility had increased to 14. And the drawdown has increased a little bit. The maximum drawdown during this time frame, and again, this is 2020 through 2024. The maximum drawdown went from a 20% decline to just under 22% decline. So the maximum drawdown, the most the portfolio lost during this time frame, did go up a little bit. But the returns went up a lot more than the risk did. And you can see that in, again, the Sharpe ratio. We already discussed the Sharpe ratio. It's return per unit risk, 0.57 to 0.8. That's a big move considering only adding 5% in one asset. So there you go. There's the portfolio impact. I think you can see at this point that Bitcoin might be something that you would consider adding to a portfolio. So to summarize, Bitcoin's very volatile. The returns thus far have definitely justified the risk in the price of Bitcoin. There is a diversification benefit due to low correlations. Studies show that even small amounts of the asset can improve portfolio statistics over the long run. So I feel comfortable in saying if you can stomach the ride, then long-term investors should consider embracing the volatility. So that concludes the presentation. I encourage you to visit the website for other videos and research on Bitcoin. You can reach out to one of our financial advisors to discuss further. And we are happy to be one of the few registered investment advisors that are offering an opinion on this asset. So thank you for your time.